good afternoon, or I guess it's still morning. I'm standing between you and lunch. So what I'm going to try to do today, first of all, thank you for the invitation and thank you for the very nice introduction. One of the pleasures I have of being dean is I get to come out and talk to people who do important things in the real world, and I really enjoy the opportunity to interact with people. So I'm going to try to run through a couple of different ideas or areas that both rely on my own or draw on my own area of expertise, but then at the same time will hopefully engage topics that you're interested in. Now, those areas of expertise are sometimes seeming somewhat divergent, but as I was thinking about this talk today, I actually think that there's an interesting way that they do converge. And they converge around an issue that, to my mind, is becoming all too clear in the American economy today, and has, I think, potentially perilous consequences. And it came to me, it comes often up as an issue, but yesterday I was out at the Milken Institute, Milken's Global Conference. It's an impressive event, and many philanthropists and leaders, thought leaders from around the world are there. And I was in a session in which there were 6 billionaires sitting up on the panel talking about their philanthropy. It was very inspiring to hear about. Most of them are interested in medical research because that's sort of Milken's main area of interest. And there happened to be the individual from the NIH, the director of the NIH, in the audience as well. And towards the end of the session, one of the things that ensued was a little bit of an antagonistic dynamic between the director of the NIH and one of the individuals who was sitting on the panel, because the individuals on the panel were in some sense very dismissive of governmental funding, governmental involvement, taking the standard line that anything that comes out of the government is fundamentally inefficient, it's just dramatically bureaucratic and impossible to get things done, and we, the billionaires, are much more effective because we can get things done quickly, we can target it, and we're doing a great job at it. And the director of the NIH said, okay, I get the bureaucracy part. I wish we could be having a conversation about this rather than throwing bombs at each other. But we do fund $31 billion worth of medical research a year. The private philanthropic money that's going into this, all due respect, is about 3. And so, I'm not claiming that we're efficient, but there's got to be a way we can work together to actually figure this out and leverage the resources that are here and that are set aside for this, but at the same time maybe learn from you guys and figure out the efficiency. And I don't think the two really saw eye to eye because it was such an entrenched way of thinking. And my great fear, of course, is that this mindset is just one that has become so dominant across the political spectrum. And to my mind, from the work that I've done on nonprofit organizations and the work that I've done on China, I can't help but thinking both sides are wrong. It is, first of all, the case that governmental bureaucracies are often inefficient, but they have certain resources and certain overarching strategizing things that are necessary for guiding an economy. On the other hand, it is often the case that the private sector actually can think innovatively about things and draw on that innovation, often that comes from embedded practice within the business world that people come from, to actually really then effectively take new initiatives more seriously, more quickly. And so I'm going to talk about 2 specific cases today that I really think actually signify that or illuminate that dynamic. One is about a very specific thing in U.S. history not that long ago, and the other is about what's happening with China and why I'm so worried that we're falling so far behind in this country. I'm going to try to race through some stuff so that I can leave some time for questions at the end. But I'm a professor at a business school, or at least I used to be, and I'm very used to being interrupted all the time. So feel free if you want to jump in or need something clarified or want to talk about something different and go on a tangent. That's fine with me too. So I want to just give you a very brief history of public-private partnerships, and it's a little bit of a different history than most people know. Now, when I usually start talking to students, particularly MBA students, about what a corporation is, It's usually framed as a little bit of a trick question, but I want to get them thinking about how important the corporate entity is for society. This is a very, very special institution. It's not just about economic organization or reducing transaction costs. In fact, the corporation allows us to do things that we otherwise wouldn't be able to do as private citizens. It allows us to take risks and be protected from the liability for those risks. That is a tremendous opportunity, but it's also a very important responsibility. And so I'd like to remind students that going out into the world and working for these institutions is a very, very special institution and a very, very special opportunity in its own right. Now, in the 1970s, we started to see a reframing of the debate around the economy and society structure that we had. Up until that period, we lived in the United States in something that I'm sure you've heard of, is often referred to as the Keynesian welfare state. John Maynard Keynes was a great economist from Cambridge, and he had built up a concept that was widely held as the economic dogma from Europe to the United States, that you kind of need a mixed economy. You need some state involvement, a welfare state apparatus, and then you need a healthy private sector. 1970, I think, was the real shot across the bow in the United States. And probably the United States became the leader in this way of thinking fairly quickly. There was a famous article that I like to mark as the beginning of this moment, but it really was bubbling up for years. This was just Milton Friedman's coming out party. He had a cover story on the New York Times Magazine that basically made the case that corporations are only responsible for one thing, and that is profits. Profit and profitability and their relationship to their shareholders is the only thing that matters. Of course, as the 70s went on, we had a period of stagflation, and the economy was in a lot of trouble, and a lot of tensions between corporations and unions. And by the end of that decade, Milton Friedman emerges as a true rock star. He has his own best-selling book and a TV show and becomes Ronald Reagan's economic advisor, and the rest is history in many ways. Recently, there's been a much more widened view of what we might call stakeholder theory. The view is that shareholders aren't the only thing. There are lots of stakeholders that are important for organizations, and we need to think broadly about this. And so we see a lot of the discussion these days about social movements, advocacy organizations, all kind of pushing corporations, even if it's only in their own economic interests, as Nike learned in 1997, to actually be engaged with community involvement. So the conventional wisdom of this is really that the power of social movements and the power of advocacy organizations have put up a demand for corporations to behave differently. My own view is a little bit different on this. I think that we've become engaged in a much deeper dynamic of public-private partnerships, in part because of the history of corporate law. So I'm going to race through that very quickly, and then I'm going to get to really a deeper conversation about not just corporations, but corporations' relationships to nonprofit organizations and why those relationships are so crucial. And they are not just crucial for getting things done and for sharing different perspectives and resources, but they are also crucial because they are at the heart of the fabric, what I call the institutional fabric of American society. And we need to really build and foster that, and that's what I imagine a group like yours is part and parcel to. So very quick historical perspective here. I like to think of corporate entities as being really built around three basic concepts of citizenship, much like our own individual citizenship concepts are built. We pay taxes, we have liability for harm done to citizens, and we influence the rules of the law of the land. Now, the interesting thing about corporations today is, although it was not intended to be this way when the Constitution was written, is that corporations are in somewhat more favorable positions than individual citizens on each of these fronts. For example, if you look at the tax burden of individuals in the United States over the course of the last half of the 20th century, you see a fairly steady state at about 9% GDP. In the corporate world, that has changed dramatically. Now, I don't need to put this up here as a critique. It's much more of an opportunity to really say that those resources have declined in terms of the tax burden, but it has also translated into a lot more social investment coming from the corporate sector. And this is something that's to be leveraged, and it's something that's very important for nonprofits to actually understand in terms of the dynamics. The tax laws now favor this kind of public-private partnership or private nonprofit partnership, and these types of dynamics are to be leveraged in the economy today. Corporations are also special persons, and so in terms of liability, there's tremendous opportunities to actually engage in a number of different acts, and we see that across many different sectors. Some of the most famous cases, of course, came in the late 1970s and early 1980s. Everybody knows about the Ford and the Pinto case. But the main thing is to really think about the liability and blame that corporations have, because again, that means that if as a business school dean, I'm going to send students out there into the market with a knowledge of how to build complex financial instruments and mortgage-backed securities, I better give them a sense that what they do really matters for society, because that normative sense is all that matters. We got no other leverage on that system. Now, there's an interesting story, just if you're curious about how we got there. As I mentioned a few minutes ago, it wasn't initially the case that the founding fathers wanted corporations to have that much power in the United States. They actually left corporations out of the Constitution purposely to say this is a land of individuals and individual civil liberties reign supreme. But this corporation thing, they are not legal persons and we're going to leave them out of it. And we'll actually leave it to states to really figure out how to govern the corporation. So states' rights became a very important thing there. There was an interesting moment, though, in 1819. It was actually a case of Dartmouth College rather than a private corporation, in which legal personhood was granted to the corporation. And suddenly we had a much different kind of entity that was legal person in its rights, but was no longer governed by the federal government and the Constitution. And so as states begin to compete for resources, we see a very different kind of economic structure emerging. So there's lots of things that are interesting to that history, but I just like to start our conversation there because I think it's a really important one. Now, there is something that is really deep and important in all of this, to think about the community involvement question. Because if we go back to where I started, this question of should we have the private sector over here and governments over here, this sector is good and innovative, this sector is bad. What I'm really interested in is the ways in which governmental law becomes a facilitator to build bridges between corporations and nonprofit organizations. And so that's what I'm going to talk about today. I'm going to talk about a case that might seem a little far afield from what we're doing today because it goes back to 1985, but I actually think that it applies to a lot of the things that we're dealing with today. So I'll make that segue in the third part of my talk. So I'm sure many in this room are old enough to remember that American cities were in an absolute crisis in the 1970s. The city of Cleveland, the Ohio River was often on fire, and places were just bombed out ghettos in many northeastern cities especially. And white flight and just suburbanization in general had just created such a desolate land within the cities. There are plenty of books that were written about this. William Julius Wilson was a very famous character in this debate. And the government was trying to figure out what to do. We need to mandate laws that are going to actually change the economic structure of inner cities. So they passed a number of mandates, right? The Fair Housing Act, the Equal Employment Opportunity Act, the Home Mortgage Disclosure Act, and finally the Community Reinvestment Act. The last of these was probably the most interesting because the Community Reinvestment Act said you have to pay to play. If banks want to have ATM machines, so this is the world before ATM machines, but the equivalent of them, in an inner city area, you also have to be invested in those communities. You have to put resources in there. And the idea was banks would give mortgages, right? And so there would be no more redlining, and there would be no more of the issues that were under fire at that point. The interesting thing was this did not work. This kind of mandate does very little for actually changing behavior. And here's how. This is sort of a model of what we might think of as a classical welfare state system. Welfare state systems work by you tax, then that money runs through the government at a relatively low level of efficiency. Usually, many cents on the dollar are taken away for the bureaucracy. That money is then allocated to some governmental organization, which takes more of those resources, in this case, the housing and urban development. Housing and urban development then contracts with the developer, and the money flows back and forth. But it's basically a standard system of redistribution of wealth, right? So what happened with the Community Reinvestment Act when the government said to banks, if you are going to be involved in this space, you have to be invested in these communities? Banks basically still didn't see that mortgages were very important things because they just didn't want to take the risk. But they did start giving small $10,000 grants to community-based organizations. But this was not very helpful because the whole issue was to change behavior of economic practices in order to foster urban development. But what you had here was banks could get their Community Reinvestment Act credit by just engaging as philanthropists. It was nice, but it really didn't change inner cities until 1985. In 1985, there was a very small accidental piece of legislation that was passed in the Economic Recovery Act of 1986. So it was a lead up to the Economic Recovery Act. And in 85, they started talking about a piece of legislation that would change the face of American cities, and it would change the face of corporate community partnerships. And that was a piece of legislation that was called the Low-Income Housing Tax Credit. Now, to understand the Low-Income Housing Tax Credit, let's go back to our model. So there were a number of people in the initial tax law that was passed under Reagan in 1981 that were running around trying to figure out what to do. How can we rebuild these cities? How can it be that the city on the hill has such awful, embarrassing structure to its inner cities? How can we live like that? And so the government thought, and this went along with the Reagan-era logic, which was always a good way to think about things, is if you give people incentives, they will actually engage. So let's give people something that's called the passive loss provision. So most corporations, if you have machinery and assets, you will have a passive loss write-off for all of your goods, right? So why don't we give individuals that ability? And then they can buy income from these very, very poor areas and not worry about taking losses on it, but they will be then the landlords of the inner city. Well, what happened, of course, during that time period was it was a debacle because a lot of people bought rundown areas and had incentives to let them become more and more rundown because the depreciation would be greater, right? So tax write-off would be even better than you thought it would be. And by the mid-'80s, people in Congress knew that this was a disaster. So they said, we have to do something. Let's change this law, and we're going to take away the passive loss provision, but we're going to introduce something called the Low-Income Housing Tax Credit. Now, that Low-Income Housing Tax Credit will be great because it will be a dollar-for-dollar write-off against your investment. And so that's good, right? But you will still have the incentives to actually maintain because you want to see property values rise. But nobody wanted to buy them. And then there was an individual named Joe Hagan in Cleveland who had an idea. He said, wait a second. Individuals no longer have passive loss, but corporations do. So what if we took this tax credit, which is a dollar-for-dollar write-off against taxes, and we put this passive loss piece together, which we already know works because it worked. They've had it working for housing from 81 to 86. Then that would be a really good deal for corporations. Actually, they're going to get a double tax break that will make the situation for them so worthy of investment that this is where the resources are going to flow from, right? I remember when I was interviewing this guy once, I was trying to track down the history of how this all happened because it really was a mistake in the tax code. And I remember sitting there across from this guy, I'm like, you're the guy. You did this. You created this system. There was one individual who was running a nonprofit organization who came up with this innovative idea. Now, interestingly, a lot of times it's in the news, and you saw my chart about taxes. So GE was recently in the news because Immelt is helping Obama think about economic recovery, and GE paid no taxes last year. Usually it's because of the low-income housing tax credit. Corporations are the major muscle behind the building of low-income housing in the United States today, and they have transformed our cities. Now, so if you think about that model, right? That's a very simplistic model. Here's what the flow of resources looks like today. Now, I won't go through all of the flow of resources, but I'll just point out two things. One is that you'll notice the U.S. collector is gone. Right? The U.S. is no longer taking money from the corporations. The money is incentivized to flow directly. Right? So you kind of eliminate the inefficiency of that part of the process. But you still have an allocation. So you can't eliminate taxes completely, but you can actually channel those resources very effectively in different ways. The second is just look at the complexity. I mean, it's just a flow of resources that could only come out of the private sector, and it's the flow of resources that are incentivizing everybody to actually rebuild what couldn't have been done before. And so today, this is the major builder of all low-income housing in the United States, and it's a story most people don't know. I remember when I started studying corporate philanthropy, when I would go to talk to the CSR officers and the accountants in corporations, they would say, you really need to study low-income housing. And I said, low-income housing? What does that have to do with corporate philanthropy? But of course, it does turn out that on the accounting side, this is really where all the action is. Now, in order to think about that, there are many places, Cleveland, Atlanta, that have different configurations of the relationship between the corporate community and the nonprofit organizations that exist there. But there has become, in many of these cities, a very dense network of ties that, in my view, is often underestimated in the nonprofit community. It's often the case that people think about funding, they always think about foundation funding or governmental funding. What people often miss is that since the 1950s, corporations have been building corporate foundations, and also on the accounting side, most of the low-income housing tax credit money doesn't even come out of corporate foundations. It usually comes directly out of the accounting office because it has such major budgetary implications. Billions and billions of dollars flow from banks now into the rebuilding of inner cities, and the story is just about as good as it can get. So the one thing that I'd like to talk about here once again is that the important thing is to always think about building the dense institutional infrastructure that sits in the space between corporations and the nonprofit community. Are states bad? Well, they're probably inefficient, but they do have an overarching strategizing approach, although in this case, maybe you're skeptical about the strategy since it was an accident in the tax code that allowed this to happen. But nevertheless, there is a dynamic in which states play this facilitating role that brings the corporate and nonprofit community together. Just as a side note, and this is a little bit of a segue for what I'm going to talk about next, there's been a lot of talk about renewable energy and how we do big things and we're moving forward in renewable energy. But everybody who's in this sector knows that we are falling so far behind. And I think one of the reasons, it's a small reason, but it's one of the reasons that we're falling so far behind is because they missed the lesson of the low-income housing tax credit. Tax credits alone don't solve these problems. What solves these problems is tax credits plus a big set of incentives to engage the corporate community, to build ties to local organizations that actually then foster the development of a sector effectively. And so it's not a surprise to me when I look back at this based on my own research on the topic, because I just think they haven't really thought deeply enough about what the issue is. Now this is a segue, because what I want to do next is I know that Joe had asked me to both talk about the role of the nonprofit in society, but also to talk a little bit about an economic forecast. And in order to do that, I've decided I'd talk about the issue that I know the best, which is China, but to frame it in a way that really kind of gets around this particular segue, which is, why are we falling behind in renewable energy? And what does it mean that we are? And what does it mean for how we think about the relationship between the market and the state? Now here again, just to highlight what I said at the beginning, is that my view is that both sides on this issue are wrong. We need to have overarching strategizing that comes from whatever we want to call it. It could be industry associations, which we had a very rich set of industry associations in this country in the 1950s and 60s. They've all kind of died off, and we've become much more segmented. For example, the Federal City Council in D.C. used to play a very, very strong role of basically effectively kind of being behind the scenes guides of the way that industrial development should be happening, but we just don't have that overarching view of how important strategizing around industrial development is. And we don't have enough investment. So I just want to talk about this a little bit and see where that takes us, and then we'll hopefully have some time for questions and comments. So, as I mentioned, this is pretty well known for people who think about not just renewable energy specifically, but people who also think about the state of the American economy today. I hate to be, a doom and gloom person, but I do have to tell you, as a dean of a business school who thinks about macroeconomic issues a lot and who thinks about jobs for my students, I'm actually terrified at the precipice we're sitting on right now. I think the state of the U.S. economy is in a very, very, very significantly bad position. And I just don't see the two sides coming together to figure out what to do about it. It's not going to happen. I mean, I too often hear people saying, yes, but American innovation is going to get us out of it. It's going to be wonderful because we are the most innovative country in the world and we've done it before. Yeah, we've done it before. When we did it before, by the way, we were much more open to a group to an immigrant class who basically helped us build the productivity revolution of the 1950s, which was mainly Chinese and Indian immigrants. Most of them go home now, or they don't come here in the first place. But the second thing is we have also destroyed vocational education in this country for the last 30 years. Now, if you look at the numbers, they're always a little deceiving. People always talk about vocational education. They say, no. Look at the numbers. They're up. Vocational technical education is high. But I'll tell you a quick story about that. It has been the case over the course of the last 30 years that we have removed all skilled labor vocational education programs and replaced them by computer programs because we wanted to be in step with the computer revolution. That's all fine and good. But if you are, say, I was a couple of years ago out in Cleveland advising a company on their China operations, and the VP for Human Resources was saying, well, we really hate doing this. We do not want to move to China. It's actually going to cost us more money to move to China because of all we have to build in protecting our IPR. But we have no choice because we actually, we just have to do it. And I kept saying, why do you have to do it? I don't want to understand what you're saying. He said, we cannot find the skilled labor here. And I said, come on. Unemployment rate in Cleveland right now is 9%. You're telling me you can't find it? He's like, there's no vocational schools anymore. The skilled labor doesn't exist. And you will hear this time and again if you talk to companies deeply about what their motivation for moving to China is. And so it's just one piece of the puzzle. And it's a piece of the puzzle that I think is really, really in a position of hurting where we are in the U.S. economy today. It's interesting because we think a lot about the challenge we're having from China. People don't talk about the challenge from Germany. I don't know what the reasons are for why those two are separated so much, but we also have a trade imbalance with Germany. Germany is much more like China's economy today in that they have a very, very strong vocational track and their skilled labor is much better than ours. Right? So when we hear about companies like Evergreen Solar, which I'm going to talk about in a minute, going to China, it's not just about the cost. It is about the fact that we have a segmented labor force that doesn't actually allow us to be productive in the sectors that we want to compete in anymore. And so I think that there is a major concern. But back to my story. So why is it that China is surging ahead in renewable energy and we're falling behind? We already talked about this great tax credit that was announced. But it's an interesting thing to think about the differences in approaches for how this industry develops. So as China invested $34 billion last year in the development of renewable energy, we invested very little, had a tax credit set up that is nominal money, but it's not true investment. It requires other underlying assets. And meanwhile, we file suits against China for stealing our jobs. Now, there is a general sentiment out there, and I'm guessing some people in this room have this view, that China is stealing our jobs. When we talk about things like Evergreen Solar leaving for China, we think about it that way. And I'm going to tell you a little bit of a different story about that in a minute. But my point is that when we think about these issues, we tend to think about them in high-profile symbolic ways. So people may remember when Jimmy Carter put solar panels on the top of the White House. And then George Bush took them off, and then Barack Obama put them back on. there's some value to those symbolic acts, or giving a talk in front of solar panels and giving you a sense that I really care about this issue. We can talk about how we do big things. But meanwhile, China's investing, right? Now, it was actually interesting recently. This is just sort of a side note. One of my favorite companies in China is a company called Evergreen Solar. They're just a very, very powerful player in this sector. And it was to my chagrin this summer during the World Cup when I was like, okay, China is advertising Evergreen Solar and we're advertising McDonald's. It just doesn't seem, it just seems like that's it. There it is. So let me tell you two quick stories about this, though, that I actually think kind of give a different spin on the idea that China is stealing jobs and instead creates a dynamic in which we need to think about competitiveness. The most important question is not whether we have an openness to a private sector. The important question to me is, are we business friendly? Now here, when I talk about China, I think this is often the most controversial thing I say, but I fully believe it to be true. This is drawn on 20 years of research in China. I've lived in China. I'm there 4 or 5 times a year. We're at GW about to build a very major presence in China. How is it the case that the largest communist society in the world is more business friendly than the largest capitalist economy in the world? How can that be? And I would argue it's not just more business friendly, this is a more dynamic capitalist economy than we are. We have lost our way in thinking about how to do this. So let me give you an example. Recently I was having lunch with Chad Holliday, who's the former chairman and CEO of DuPont. He's now the chairman of the board of Bank of America. And I was talking to him about this, and the fear about joblessness and everything else that's going on. And we were talking about China. He said, you know what, I have a story for you. This one, you're telling my story. So when I was at DuPont, we were in the market for a new photovoltaic array factory. We wanted to build it. We knew we wanted to build it somewhere. We weren't sure where. It would have been fine to build it in America, but to be honest, I wouldn't have even known who to call. Like, there's just not that kind of governmental relations stuff that happens at the local level as aggressively as in other places. Then China and Singapore both heard we were in the market. We didn't call them, they called us. They got into kind of a bidding war with each other. And eventually, we went with the Chinese. So we started building this photovoltaic array factory in Guangdong. We put the research R&D facility right across the border in Hong Kong so we could protect the IPR a little bit better. Everything was going full steam. And then 2008 hits, the economic crisis. And, as the chief officer of this organization, I felt I had a fiduciary responsibility to be prudent. And so I called up our Chinese partners and I said, look, I think we're going to have to scale back. We can't do a research facility that's as big as I thought, and I think I'm just very nervous. And he said, why are you so nervous? And he said, well, the economic crisis. Wouldn't you be nervous? And they said, what do you need? And he's kind of, offhandedly said, well, 2 years of procurement would be nice, guaranteed procurement. And they said, done. Don't even think about it. Like, we'll guarantee prices, we'll guarantee procurement, and we'll see from there, right? So there they are. Similar story happened with Evergreen Solar. This one's more recently in the news. People remember this one because I guess around December, or maybe January, Evergreen Solar announced that it was closing its doors in Massachusetts and it was moving to China. And a lot of people were very upset with this one because Evergreen Solar had been rolled out as a very, very big political win for the state of Massachusetts, creating jobs, building renewable energy, and here 2 years later, they're shutting their doors. How can that be? But here again, the story is a complex one. So it turns out that Evergreen Solar had about 1/7 of their bond issuance from Lehman Brothers. Now, when Lehman Brothers went under, they lost all that money. They, of course, went to the government and said, look, we're in a bind here. Can you give us some TARP funding? And the government said, well, you're not a financial institution. You got to go to the banks. Now, of course, at this point, we all know the story well, that a lot of the banks took that TARP money and were sitting on it. They were not making loans until they saw how the economy was going to shake out. And so here was Evergreen Solar trying desperately to get a federally guaranteed loan or to get some kind of infusion of cash to make up for what had happened with Lehman Brothers. But there was just nothing there for them. And so for Evergreen Solar, the option was, okay, either I close my doors and we don't operate anymore, or we go somewhere and trying to put together a deal that was very similar to the DuPont deal, and the rest is history. I will say on a positive note that there are more exciting positive stories here. Recently on the south side of Chicago, a major solar array was built, and that was actually not only the private sector but also the nonprofit sector actually coming together and lobbying for this kind of change, and basically using vacant lots in the inner city to rebuild this industry that is so crucial for our future. And it's crucial for our future not just because of the economics of it, but because a lot of people in venture capital and in science believe that this is where the next wave of innovation is going to come from. So there are some good stories. Now I just want to talk about 3 quick lessons that I've learned that come from my China research that are really, I think, important for us all to understand, not just in this notion of state-market relationships, but also in the notion of how we guide our economies. The first lesson is gradualism. In the US, we tend to have economic models that have core features that we assume to be true. There's a lot of assumptions. There's a lot of elegant math. But I guess it was Dick Thaler who famously said, if economic models don't adhere to reality, then so much the worse for reality. And that's it's a sort of fun, academic, playful kind of statement. But the reality is that when you build models based on that and build economies, you know what? Sometime you're going to have an economic crisis that will adhere to reality, and you will lose trillions and trillions of dollars of value in the global economy. And that, my friends, is really, I think, the story of 2008. And so I think that there's a real crisis that exists here. The approach that is different is gradualism. Gradualism is an approach to building economies. In China, they like to say something about the building of the economy as groping for stones to cross the river. And it means that you're sort of feeling your way. You know what the general concept is. Economic dominance and power and world power. But the approach of how you get there is always going to be from the bottom up. And I think building these economies from the bottom up, institutionally and in community basis, I think is the best way to do this. The other thing that's really crucial here is we focus too much on private property. Right? So we think that the government takeover of GM was a horrible thing because we know governments are inefficient. I think most people have forgotten very quickly that GM was pretty inefficient. Right? And so it doesn't have anything to do with the property rights. What it has to do with is competition. Competition is the core of capitalism. There is no other issue there. And so economists were puzzled in the 1980s because China was experiencing double-digit growth, yet they claimed that they hadn't privatized the industry. How was that happening? It's impossible. We know from our economic models that state-owned organizations are fundamentally inefficient, so they must be lying. Turned out they weren't lying, but they did do something that was very innovative, which was they didn't privatize, but they localized. So you have local states competing aggressively with each other to come up with amazingly innovative approaches to develop new types of industries and models. In China, the number of competing localities is astounding. If you've spent time in China, you've probably been to Shanghai and Beijing, very nice cosmopolitan cities, but I would urge you to go to places like Suzhou, Dalian, Xi'an, Chengdu. These are the places where the real innovation is happening. In the case of Suzhou, it's one of my favorite places in the world, and many business people will tell you that it is one of the best places to do business in the world. Suzhou is interesting, though, because they borrowed a model from Singapore. They got a $9 billion investment from the Singaporean government to build an industrial park there that is one of the most innovative public-private partnerships I've ever seen. And not only is it an incredibly innovative public-private partnership, but the Industrial Park Commission itself, which is a state organization, is preparing to go public on the Singaporean Stock Exchange. And so there's a very interesting model of tiptoeing across those lines. The other thing that we have to have, and I know I've already said this, but it's really important, is we have to have cross-industry strategizing. If we don't get back to this the way we did in the 1950s, I think we're going to be in real trouble. This actually gives rise to what many people dislike, which is called China Inc. If you talk to people in the oil industry, for example, one of the things that's really frightening is that every time they put a bid in for a contract, they're not just competing against PetroChina. They're competing against PetroChina plus Air China plus the hotel industry and everything else that gets put into that. And so we can't compete with that unless we figure out how to coordinate across industries. But the final one that I think is really important, and this one is, has been a bit of a hobby horse for me lately, because I think we're living the 1980s over again. Some of you may remember that in the 1980s, Japan's economy was the #1 economy in the world. Very similar to the situation as right now. They had the largest number of, they were sitting on the most US debt and the most cash. And they had to reinvest that cash, otherwise the cash basically loses value if they just sit on it, right? So they started doing things like building a Subaru plant in the Midwest. Toyota built some plants. They bought Pebble Beach. And there was a lot of anti-Japanese sentiment. A lot of Japanese that you will talk to from that time period will tell you it was not fun to be a businessman in the US. We're seeing that again today. Here we are. China sits on more debt than any other country, sits on more cash than any other country. They desperately want to invest here. Now, sometimes Congress or the President steps in and says, well, it's a national security issue. Right? So when CNOOC, China's National Offshore Oil Corporation, tried to buy Unocal, they said, we can't do that. We just can't let it happen. Okay, so it's a national security issue. And then when they, more recently, Huawei attempted to buy Freeleaf, we said it's a national security issue. Telecommunications is off limits. But when Haier tried to buy Maytag, I'm not getting that washing machines are national security. I'm not grasping what the connection is. And I think at that point we just have to question, we're in a situation in which we live in a global economy. We can no longer do it on our own. So I don't actually have any major concluding points except to say that I believe our economic forecast right now is a little dire, and I hope I didn't just depress everybody before lunch. Because I actually do think that there's a bright spot here. We have the best university system in the world, and we have the most vibrant nonprofit sector in the world. And if those two sectors actually can align themselves with the private sector, and then the government can do the right things in terms of facilitating these relationships, we can save the country the way inner cities were saved in the 1980s and 1990s. So I want to stop right there. I know we just have about 10 minutes left, and Joe suggested that maybe we should have a couple minutes for questions and answer or comments. So I'll just end there. Thank you.